Assalamu alaikum, myself Ummi Rabia. I would like to continue with the chapter number 4, that is business services, and we are doing one very important topic of business services, that is insurance. We are all very aware about what is insurance. It is a protection from financial loss, kind of risk management which is primarily used to hedge against the risk. Then it is a contract between two parties, insurer and the insured. We have already studied all these things in the previous lectures. Now we are studying what are the various types of insurance. There are three main types of insurance. First, life insurance, second, marine insurance, and third, fire insurance. The marine insurance we have already covered in the previous lecture. What are the various types of marine insurance? Today we'll be studying about what do you mean by fire insurance and what are the various types of fire insurance. Fire insurance, by the name itself, it says that an insurance which is taken against the risk of fire, risk or loss of occurrence of fire. It is an agreement whereby the insurer, that is the person who takes the insurance, gives certain consideration. Sorry, the insurer, that means the company which is giving the insurance, is taking certain consideration in order to indemnify the person insured against the loss of property due to fire. Okay, then what are the various types of fire insurance? The very first type of fire insurance is valued policy. Value, by the name you can say there must be certain specific value for this policy. What is it? Under this policy, the value of the subject matter of insurance is agreed upon at the time of making a contract. The insurer has to pay specific amount or value irrespective of amount of loss caused due to fire. Okay, this is important. Like there may be certain things, there may be certain properties which are invaluable, which cannot be actually valued. Like there are certain people, for example, if we talk about art galleries, paintings and all those things, where we are all aware that modern art is very unpredictable. There may be certain people who will be giving you lakhs of rupees for one painting, and for the other person that painting is not even value of rupees 100. So there is a difference. You cannot value that product after occurrence of loss. So it is fixed in advance. It is fixed in advance because the value is not predictable. So what do? You fix a certain amount. Like for example, there is a painting in my art gallery. I would like to fix a value of 10,000 rupees. If loss occurs, the insurance company will give me 10,000 rupees. Okay, for example, policy can be taken for artworks, sculptures and paintings. What is the second type of fire insurance policy? Average policy. Okay, pay attention. By the name average, you can understand here. It is a policy which contains an average clause. If subject matter is not insured as per the exact market value, or it is undervalued, then the insurer is liable to pay that percentage of loss for which it is insured. For example, if a policy is taken for 1 lakh against the market value of rupees 2 lakhs and loss incurred due to fire is 50,000, then the insurance company will pay rupees 25,000, that is 50%. Okay, now pay attention here. I have taken an insurance. I have my goods lying in my warehouse, and the market value of the goods is 2 lakhs, but I am not putting that goods for sale right now. Okay, if I value the entire warehouse, there is 2 lakh rupees of goods in my warehouse, but I am taking insurance policy of rupees 1 lakh only. There may be certain reasons. I have a small business and I think that there won't be any loss, so why to take 2 lakh rupees policy, I'll take only 1 lakh rupees policy. I am thinking like that, so I am taking a policy of rupees 1 lakh. Now what happens? Fire occurs. If the fire occurs, what was the average, what was the percentage of the policy that I have taken? Market value was 2 lakh, but I took insurance of 1 lakh, that is 50%, right? Right. So whatever will be the loss due to fire, I will get only 50% compensation. Like in the example given below, the loss occurred due to fire was 50,000. So what is 50% of 50,000? 25,000. That is why the insurance company paid rupees 25,000 as compensation. Okay, another example you can take: if the property is of 1 lakh and I am taking, no, sorry, if the property is of 4 lakhs and I am taking insurance of 1 lakh, what is the percentage? 25%. Okay, so in case of fire, if 2 lakh rupees loss has occurred, I will get only 25% of 2 lakh, that is 50,000 rupees. Understood? The third policy of fire insurance is specific policy. In case of specific policy, the property is insured for a definite sum irrespective of the market value. If there is a loss, stated amount will have to be paid to the policyholder. In this policy, the actual value of the subject matter is not considered. What is it? Specific policy. A specific amount, a specific definite sum is mentioned. Like at the time of taking insurance only, I will say that I want to get an insurance cover of rupees, like for example given here, a property of rupees 1 lakh is insured for rupees 75,000 and the loss due to fire is 40,000. Then the insurance company will pay rupees 40,000 in full as compensation. Okay, what was the value of the property? 1 lakh, but what was the insurance taken? 75,000. Now understand this. Here in this example, the loss occurred was 40,000, which was less than the agreed value, 75,000, right? So we got full compensation as 40,000. But another example you can write or you can understand it is that if the value of property is 1 lakh and under specific policy I have taken an insurance cover of 75,000, if the loss occurred is of value 80,000, that is more than the agreed value, more than the specific value, then the insurance company will pay me only the amount of specific policy, that is 75,000. The other 5,000 I will have to bear it. Understood? If the loss is less than 75,000, entire loss amount will be recovered. But if the loss is more than 75,000, only 75,000 will be recovered. The next policy under fire insurance is floating policy. This policy is taken for the goods which are lying in various locations and godowns or warehouses. Since the quantity of the goods cannot be measured or it fluctuates from time to time, it becomes difficult for the owner to take specific policy. So businessmen and traders take fluctuating policy. Such policy is taken for one sum and one premium for goods lying at different places. We have already studied about marine insurance policy, right? There was one point called as floating policy in marine insurance. This is exactly the same thing. Under that, if there were 3 ships and I was not sure, so I took one common policy for all the 3 ships. Whichever ship occurs loss, I'll be getting the compensation, right? Here it is same. If I have goods lying in 3 to 4 warehouses and I am not able to value the exact amount of the goods lying in all these warehouses, so I will take one floating policy, one common policy for all these goods lying in different warehouses. If fire occurs in any of the warehouse, loss occurs in any of the warehouse, I will be receiving my compensation because I have taken a floating policy for all. So it is a win-win situation. It is a good uh, thing for the businessman because I'll have to pay only one uh, premium for all the goods. I don't have to pay separate premium for warehouse 1 and warehouse 2 and warehouse 3 and warehouse 4. I don't have to pay differently. I'll pay only one premium for all the goods, and the compensation received will also be one in common for all the goods lying in different warehouses. Comprehensive policy. We all know that fire occurs due to various reasons. So, under fire insurance, it does not cover losses due to riots and war, etc. Why? Because they are man made. Like, they are actually done by people. So, but in comprehensive policy, a policy is taken for risk such as riots, war, earthquake, etc. under one single policy. Here, not only fire but also other things, other risks are insured. Basically, a comprehensive policy covers or provides security against the risk of riot, war, earthquake, fire explosions, floods, etc. all in one. You don't have to take separate policy for flood, for earthquake, for fire explosion, for riot, for war. No, you are taking one comprehensive policy for all these 3-4 things. The next type of fire insurance policy is excess policy. When the value of the goods or stocks fluctuates, then excess policy is taken from the insurance company. It is different from the normal policy because the insured will have to take not one but two policies. Okay, firstly, what I said, excess policy. Fluctuation is an important point here. Here, the value of the goods fluctuate. For example, onions. We know onion, right? Onion, at times, onion is 20 rupees kg. But there comes a time in a year where onion goes to 200 rupees per kg. It fluctuates, right? There is no certainty in the price of the onions. So, for such products where the value is not fixed, so the insurance company takes two policy. One for the minimum amount below which the value does not goes, and another for the difference in the amount. Like, for example, if the value of the stock ranges from 1,50,000 to 2 lakh, what is the minimum amount? 1 lakh, and it fluctuates from 1,50,000 to 2 lakh. That means at times it is 160, sometimes it is 170, sometimes it is 1,80,000 rupees, and at sometimes it is 2 lakhs. It does not goes beyond 2 lakh. Okay, it does not comes below 1,50,000 and does not go above 2 lakh, fluctuates in between. So what is the minimum amount? 1,50,000. So the insured will take one policy of the minimum amount, that is 1,50,000, and another policy for the difference. What is the difference? 2 lakh minus 1,50,000, 50,000. That is the excess amount. The another policy will be taken for this excess amount, that is 50,000 rupees. Another example will say, if it ranges from 1 lakh to 1,30,000, first minimum amount is 1 lakh, so we'll take one policy of 1 lakh, and another difference is 1,30,000 minus 1,30,000. So the amount of excess policy will be 30,000. Two policies, 1 lakh and 30,000. Understood? Okay. Now, next point is reinstatement policy. This is a type of policy where the insurer undertakes to replace the property of goods lost by fire. Okay, here the insurance company is not paying you any compensation, no amount of risk is covered. Directly, the new product is given to the insured. Here, the insured does not want to take money. What he says that in case of occurrence of fire, I want to replace my old product with my new product irrespective of the amount of loss. Okay, in this policy, instead of paying compensation, the property lost by fire is replaced. If I have a bike and it is lost by fire, it will be replaced by another bike. While paying compensation, the depreciation amount is not taken into consideration. Like if the value was 60,000 at the time of taking policy, so at the time of occurrence of loss, a similar amount of 60, a similar product of 60,000 rupees only will be given to you. Okay, the rate of premium is higher in reinstatement policy. Yes, the rate of premium is higher because the insurance company have to give you an entire new product. For that they need money, so they want to take more money from you so that they don't have to bear the entire loss. Okay, the last two types of fire insurance policy which are newly included in the syllabus. It was not present earlier, but this time this has been included in your syllabus. That is consequential loss policy and sprinkler leakage policy. Okay, what is consequential loss? The fire insurance is originally purchased to indemnify the material loss. The intangible interest was not indemnified, right? Only the loss occurred to us, we are compensating that. Thus, the consequential policy includes the loss of tangible and intangible properties. This policy provides an indemnity to the insured for loss of net profit, payment of standing charges, and expenditure in respect of the increased cost of working. Okay, consequential policy, like for example, if I am talking about my stock lying in a warehouse valued rupees 1 lakh, I am not including the profit that I'll be getting at the time of selling it. Like for example, the stock of onions of rupees 1 lakh may be sold in the market for 1 lakh 40,000. I am going to expect a profit of 40,000, but I don't mention that at the time of taking insurance. I take only 1 lakh rupees insurance and I am compensated on that 1 lakh rupees only. So the extra or the interest or the profit is not indemnified. But in case of consequential policy, you indemnify all those things also. This policy provides an indemnity to the insured for the loss of net profits, payment of standing charges, that is outstanding charges, and expenditure in respect of increased cost of working. So here, if you are taking consequential policy, if there is an occurrence of loss, the insurance company will assess the market value of that product and will find out what would be the profit that you would be earning and then pay you accordingly. So you are getting secured against your net profits and your outstanding incomes and expenditures also in case of consequential loss policy. Okay, sprinkler leakage policy. Sprinkler leakage policy covers damage to the property caused by an automatic sprinkler system that has leaked the discharged water accidentally rather than in response to fire and smoke. However, the discharge or leakage of water due to heat caused by fire, repair, or alteration of building, earthquake, war, explosion are not covered by this policy. Yes, we have noticed this sprinkler in most of the hotels and places where you visit. You will always notice there is a sprinkler in every room in hotels specifically. Okay, if you uh, insert some smoke in the room, that sprinkler will automatically leak water. Like, the sprinkler will sense the smoke and will feel that there is a fire in the hotel, and then it will start leaking the water. Okay, so there may not be any fire in the hotel, but due to the smoke of certain other reasons, because of cigarettes or hookahs or anything else, the sprinkler leakage happens. And if this sprinkler leakage causes damages or losses, the insurance company will have to pay you compensation for that, since it cannot be covered in any other fire insurance policy. Why? Because there is no occurrence of fire. This is a fault of the sprinkler has leaked because of certain reasons. So the policy will cover only the loss occurred due to automatic sprinkler system because of unnecessary sprinkling or leakage of water from the automatic sprinkler system. This policy does not covers uh, uh, leakage of water caused due to fire. Yes, this is important. If there is a fire and sprinkler leakage has happened, so that will be covered under other fire insurance, not under sprinkler leakage policy. Understood? Thank you so much.